You're tuning into Accelerate Generational Wealth, a monthly learning series produced by SVN Excel Commercial Real Estate. Hosted by Jenna and Brian Truman, this series brings together guest speakers who are experts in their field to provide cutting-edge industry information. Whether you're new to the business or a seasoned investor looking to diversify your portfolio, you'll find a wealth of knowledge at absolutely no cost to you. Without further ado, SVN Excel proudly presents Accelerate Generational Wealth.
Yeah, things like that. So, anyway, all right, we'll get started. So, at our learning series, we love educating and bringing education to the community, to our clients, potential clients, and all that. So, tonight we have Shell Wooden she's a commercial banker with Capstar Bank here in town, and then the second speaker tonight will be Patrick Sullivan, and so we usually bring somebody that's an investor that's invested over the years and kind of tell a little bit about their story, how they got involved in real estate, how they got involved in investing, and kind of their journey. And then we usually bring somebody that might be a vendor, it could be lender-wise, could be a real estate attorney and all that. So tonight we have Shell Wooden, and so we are going to talk about lending. Everybody's favorite, right? Where do I get money to fund all these awesome deals that that we see, or deals anyway? And maybe they're not all awesome, but from that standpoint. So you want to introduce yourself about you and the number of years you've been? She got into banking when she was 5. I just want to tell you that before she goes through and talks about that. Anyway.
So as he mentioned, Shell Wooden, I'm with Capstar Bank, which is a local Nashville-based bank. I've been in banking now for 25 years.
That's why you said she got in when she was 5.
Started out, grew up in banking. I was a teller. I was a personal banker. I held my investment license for a short period of time, and then I transitioned to commercial and business lending about 10 years ago. I spent the majority of my banking career at a very large bank. So I was with U.S. Bank for 21 years before I went to Capstar. And we can talk a little bit more about the benefits of a large bank versus a small bank, but I went to a smaller bank for a reason. But that's where I'm at now. So I'm in the commercial space, and I would say about 90% of my portfolio is commercial, and the other 10% is a small amount of consumer lending that I'm able to do. So don't do a ton of that, but mainly the commercial space.
All right, excellent. So the and so one of the items to kind of talk about that I know I'd like to kind of delve into, right, is when people go to approach a lender, right, the lender's going to look at and say, okay, we need to underwrite the individual or company or joint venture, whatever, and we need to underwrite the property, right? So when somebody comes, let's talk about the individual first, right? Mm-hmm. So I know there's that lovely word out there that says, the banker says, okay, I need to get this PFS from you, right? So what's PFS?
So PFS is a personal financial statement.
Okay. And what's included usually on that?
It's basically a balance sheet of your personal It's your personal snapshot. So it's your assets and your liabilities. Most banks actually have their own PFS form, but a lot of people keep an up-to-date PFS going on a regular basis, which I actually recommend, because then when you're ready to buy a property, you have that ready to go for the banker. At Capstar, we actually have a form that's called a certification form that allows us to use your individual PFS that you've created, so that you don't have to fill out the one that's on our letterhead. But it's essentially a snapshot of your assets and liabilities and your personal information.
Okay, very good. All right. And so when somebody brings that, what else do you need from them?
Lots of things.
Okay. Name them.
So we typically need, sometimes it depends on the size of the property. Sometimes it depends on your experience. One thing that I would recommend everybody do is you kind of create a resume or a bio of yourself. That's very helpful to us as lenders. As much information as we can get on the front end. I think one common misconception is people think that they have to have real estate investment experience before they can buy an investment property, which is not true. We have people all the time that have an excess amount of cash flow and they want to start investing in property, and they form an LLC to hold the real estate. So that bio will give us a background of what have you been doing, why are you a good prospect to purchase real estate property, what's your history, things of that nature. In addition to that, from a financial perspective, it's usually 2 to 3 years of tax returns, proof of current income, because if you're buying property, we still want to know that how are you generating current income. And that can be a number of things depending on how you're currently employed. You might be a self-employed individual, and if you are, please keep up-to-date financial statements on your business. Banks typically don't want to see financials that are any more than 3 months old. So right now, for example, I have lots of business owners who have not even completed their 21 returns, which is completely okay, but you need to have 21 P&L, you need to have Q1 P&L. So you need to keep those things up to date if you're looking for lending opportunity. And then if you're employed through a company, it's as simple as a couple of pay stubs and W-2s.
So it's probably not a good idea to quit your job 2 months ago and then come to you and say, hey, I'm buying this real estate stuff now.
Unless you just are sitting on a ton of cash and you can back that up. I have had a couple of situations. We've had individuals where they're benefactors of trust, so they, gain income from a trust. I've had business owners that, sell their business, so now they're not employed anymore, but they've got a lump sum of cash to invest, and now they don't own a business, so they technically don't have income. So we can get creative sometimes with those things, but that's a risk factor. So with any risk that we're presented with, we have to be able to mitigate that risk.
Yeah. Okay.
So.
Perfect. And then let's talk about, so taking a look at the deal. Somebody brings you a deal, right? Mm-hmm. So then what do you want them to provide you from that deal that they bring?
So if they're investing in multifamily real estate, which is primarily what you're doing, we typically want to see rent roll, lease agreements on the property. The listing of the property is helpful because that gives us an idea of the demographic, the area, the history of the property, all of those things. But that allows us to truly look at a cash flow of the property, because it's not all about how much money do you have and can you afford the property, but is that property actually performing? Because we obviously want to make sure it's a good investment for you, and we need to make sure it's a good investment for the bank as well. So. Okay.
So something else that I'd like to talk about, because even as long as I've been doing this, sometimes, you hear, okay, I took a look at it, got it, I prepared the package, I send it to underwriting, who are behind some black, black screen somewhere, and they go, But so when you say going to underwriting, what does that mean for the typical investor? And out of when you send it to underwriting, who are they? What do they do with what you send them, and all that good stuff?
That's such a loaded question. Hopefully you have a banker who on the front end has had a conversation with you, and they've we call it a pre-underwriting process. So if I have a borrower, I kind of pre-underwrite that deal. I already know if that property cash flows, I already kind of know what that borrower looks like on paper. So I have a pretty good idea of whether or not I feel strongly that I can get that deal approved. Once it actually goes to underwriting, they're the ones who are doing the formal spreads on the property and on the individual. Some banks do it differently. Capstar, we look at a global cash flow coverage. Some banks look at it individually. So banks are different. So that's a good question to ask your banker. How do you guys actually calculate cash flow? Are you looking at it globally, or are you looking at it individually? So make sure and ask things like that. But that's what they're doing. They are doing the true spreads, coming up with the real numbers. It's their job, obviously, to find any little thing that they can to say. I don't want to say that they want to say no, but and then it's my job to come back and go, no, this is why you shouldn't say no. Right. So we get to go back and forth, and I get to answer all the questions. But That's why it's so important for me to have as much information on the front end.
Right.
Because if I can give them all that, then
Yeah.
the likelihood of them not coming back and asking 15 questions is.
Just 1 second, I'll get your question. So, explain what you're talking about when you're saying global cash flow, or global. If you're looking at either property or looking at the individual.
So on the
Saying
commercial
global.
side, we look. So most people are familiar on the consumer side. You hear the term debt to income. So that's a very common term that people are used to. On the commercial side, we usually look at things from what we call a cash flow coverage. So for us, we're looking at the cash flow coverage of the property, the cash flow coverage of the individual, and then we fuse those two together, and that's a global cash flow coverage. The easiest way I know how to explain it is it's like for every dollar that's going out, we want to see how much is coming in. So we want to make sure that from a global perspective, we're not, there's not money being lost.
Right.
So,
Okay.
and every bank's number is sometimes different.
Tommy, go for it.
That was my question. I have a different
okay.
question, but I'm going to hold it for later. I want to give her some time to.
Oh, okay. All right.
Okay.
Okay. Just in case she comes up with
Right.
Yeah. So, all right. And so, talk about. So, does Capstar sometimes do you guys look at maybe that property needs to have a DSR or something of 1.25 or 1.21 or something?
You heard that number.
And and maybe it's just slightly under, but the buyer is real strong. So then sometimes can that overcome
Yes.
maybe that?
So they can kind of even each other out.
Yeah.
Again, anytime we have a negative, we want to mitigate that risk.
Yeah.
So we're seeing that a lot now with property that we personally at Capstar, we want a coverage on that property of a 1.25 or greater.
Yeah.
So back
Maybe
to my
that's where I heard it.
maybe
Yeah.
yeah. So for every dollar that is being spent on that property, we want to see $1.25 coming in, basically. And we stress that number. You know, we calculate in a vacancy rate, we calculate in the expenses and all of those things, and so that's where we can come back and say, well, what really is the chance of there being that high of a vacancy rate?
Yeah.
Can we, skew that number a little bit for that? So that's where it's about the deeper conversation.
Yeah. Okay.
So, does that answer the question?
Yeah.
Okay.
Yeah.
Should I
Tommy, ask your question.
Gotta go
Let's
now
go. Yeah.
So I know that you have an option to do a loan to cost or loan to value. I'm assuming you've done both. Is there a threshold on a property whenever you're looking at it as to whether or not you decide that, okay, I'm comfortable with this, I'll do a loan to cost loan?
So that kind of is, I would say that's more so individualized by the bank. We at Capstar typically don't do a loan to cost unless it's a construction deal. So that's more of a construction type conversation. The loan to value usually is the only one that comes into play on a purchase property that's already existing. And we will do, typically on investment property, we're looking at 80% of the value of the contract or the appraisal, whichever is less.
Gotcha.
So if somebody's selling their property, at a premium and that appraisal comes back low, it's really all up to the buyer as to whether or not they want to inject that extra cash, because we're not going to finance that.
Okay.
Does that answer the question?
Yeah.
Okay.
So let's talk about